All right. Yes, I want to thank everybody for joining me today. Again, my name is Wesley Boudreau, one of the financial advisors here with the Retirement Group and now part of Wealth Enhancement Group. We're going to dig into the ConocoPhillips pension plan, kind of what's going on with ConocoPhillips right now. Talk about your different choices with the pension plan, whether it be the cash balance plan, the Conoco plan, the Phillips plan. We'll touch on some of the other plans that aren't uh, um, as common, but are still something to be aware of. We'll talk about the different distribution options you're going to see within there, and what are some decisions you need to make right now if you are forced to potentially change positions, or if you're looking at getting cut, unfortunately, from the company, and kind of our advice going forward on how to review the big picture of that. So it's kind of old news for a lot of you. Unfortunately, we went through the aspect of the cuts with ConocoPhillips, and a lot of the oil companies here in the last year or so, trying to kind of right size the ship, kind of lean up a little bit. Um, a lot of this has already kind of gone through last year in 2025. We're moving in here to 2026 now. There's probably likely still going to be some additional cuts on the tables. But again, we're looking at 20 to 25% reduction was the goal that they're going for there. We talked about the fact that there was the war notices kind of going out in Texas and others to kind of show some of these potential cuts. So the questions are going to be looking at that bottom of the screen. We're going to be looking at what are some different questions to ask yourself if you are tapped on the shoulder, or if you want to take advantage of severance and maybe go on your own. It's also going to, as far as the questions to ask, we'll talk about those different pension plans. The Title IV, Title One, and Title II are the core plans that we tend to see more often. But we'll also touch on what the other plans are there as well. So, if you are unfortunately tapped on the shoulder and asked to potentially resign or find another job in this transition process, there's a couple of different things to kind of figure out. Number one, obviously, the choice is, am I ready to retire? It may be that you're in your 40s and obviously you're not ready to retire. Maybe you're in your early 50s and you think, hey, maybe I've done well enough. Can I do this? But the hope is that maybe you're in your late 50s or early 60s and you're approaching retirement age anyway, and it might just be the ability to take that next step, whether you want it to do it or not. So the question is, am I ready to do so from a both an emotional standpoint? Is my family ready for me to retire? Is my identity with ConocoPhillips? Do I want to make a change or work anywhere else? And can I actually do so financially? And that's what our job is to do with you, is kind of take you through a cash flow analysis and run a real financial plan, let you understand the different benefits plans you have at ConocoPhillips to see, are you on the right track and can you actually retire? So that second question there, can I retire? Yeah, maybe you want to, but you may not be able to. A lot of times we've worked with individuals that don't want to retire. Their identity is there and they want to work another 3, 4, 5 years. But by all means, they could easily retire. They could have retired a year or two or three ago. On the flip side, we got individuals we're working with that say, I'm done. I want to get out of here. I'm ready to retire. I don't want to work anymore. But we need to put pen to paper, look at the numbers. And unfortunately, you can't retire. You need to either severely cut back your spending or do something differently, because maybe you're younger, or maybe you spend more than what you can actually support with the income you may be bringing in post retirement. And how does the actual ConocoPhillips plan work into this? The differences between the pension plan, what are the benefits there? Other benefits, have I saved well enough in the 401k plan? What's my age? Can I access that 401k plan without the 10% penalty? What about the healthcare retiree benefits? Am I going to have to go on COBRA? Am I able to get retiree medical benefits on there? Am I going to have to look at the Affordable Care Act or something like that? So we go through all those different options with you as well when we run a cash flow analysis. And also, do I have a plan in place? You'll notice a slide here at the very end about how few people actually have a plan in place. That's one of the things we definitely tout, is we run a detailed financial plan for you, not just looking at your spending and what you're looking to achieve, but we integrate in there the ConocoPhillips pension plan and the 401k plan, and go through those different questions to make sure you are on the right page to actually make that next step and retire. And it could be something where you say, okay, I'm not ready to retire. I know I need to go back or need to go and find something else for the next couple of years, but it may be that we run that review and let you know, hey, you don't need to actually match your paycheck you're getting at ConocoPhillips. You might be able to go do something that maybe is more enjoyable but pays a little bit less, and that's enough to support what your goals are. So again, if you haven't done one before, even if you don't think you're going to be affected, it's good to, at least if you're within 5 years of retirement, generally speaking, to run one of these reviews to see where you stand on there. So let's get into the actual pension plans themselves. ConocoPhillips got a lot of different pension plans because it's a conglomerate of different companies kind of came together over time. Some of the ones we don't talk about that much anymore. Most of those individuals are retired if they were from, something like the ConocoPhillips store, Burlington, Tosco, things of that nature. But the top three that we tend to focus on are going to be the Title One, which is the Phillips retirement plan, Title Four, which is the Conoco plan, and then the ConocoPhillips, which is Title Two. That's the cash balance plan, which those companies merged, and there is a difference between those. The Conoco plan and the Phillips plan are your classic defined benefit plan, in which case there is a actual formula that's going to determine what your single life annuity is going to be, and from there all other different distribution options are calculated from it. That formula looks at your final average, the your highest three earning years, your final average pay, times multiplier, usually 1.6%, times years of service, and an offset for Social Security, where they claw back the Social Security half they've been putting in there. That's another thing to keep in mind. If you were not at the firm your entire career, maybe you worked public sector or something like that, let us know, because it may be they've got your Social Security overcalculated, and that may be a negative impact against your actual pension calculation, where we can make some adjustments there and get more money back in your pocket there as well. So let's kind of go through some of these. So again, the Title IV, again, the classic defined benefit plan, in which case that formula determines what your single life annuity is. But if you were part of Conoco originally, in order to be eligible for this plan, you need to wait until you're 50, and you've got 10 years of service to be eligible for that. And the normal retirement age here is age 65. Doesn't mean you have to wait till 65. It's just that's what the normal retirement age is. And then if you look at this chart here, if you look at actually leaving before age 60 and commencing your benefits before age 60, you're going to get a reduction in your actual pension by about 4% each year. So again, if somebody is actually retiring and commencing their benefits prior to age 60, they're not going to get 100% of that pension. They may only get, in the case of a year short, you're going to get 96%, and then 92%, and so on and so forth. But you do have that eligibility to take it as early as age 50 in here. Now, the Phillips plan is very similar, but a little bit different as far as eligibility and when you can actually take it. You can't take it as early as 50. You have to wait until age 55 in order to take that. Normal retirement age is still at 65. But again, there's the distribution. If you take that prior to age 60, you're not getting 100% of that. You're going to be getting a reduced amount, and it's not as favorable there. It's actually going to be about a 5% reduction each year. And if you look on that right-hand side, if you do happen to leave before age 55, again, you can't take it till 55, but if you leave before 55, you're going to get hammered even more. So again, if you retire at 55 and take it at 55, you're looking at 75% of your pension. But if you, let's say, left at 54 and took it at 55, it's 40% reduction, or 40% of that pension. So a 60% reduction. So a huge difference. So again, you theoretically can leave before 55, but you want to make it till 55. Again, if you came in with the Phillips plan, chances are most of you that are still around have already made it to 55. But again, to be aware of that, God forbid that you do get tapped on the shoulder and you're a year or two shy of that, it's something to be aware of and look at that option there as well. Now, if you came on after the merger and you're in the ConocoPhillips plan, the cash balance plan, this is different, in which case instead of a formula to figure out what your single life annuity is going to be, you're getting contribution credits each year based upon your years of service and your age, and that's going to grow at the 30-year Treasury rate. So again, wasn't that great of a return historically. Now it's getting a little bit better with the interest rates having been up the last couple of years or so. But again, it keeps that more of a fluid account where you can roll that over anytime you leave. You got more direct access to it. But it's based upon your age and years of service. So if you had points under 44, so let's say if you were you came on, you're 30 and you had 10 years. So that means you start at 20. So let's say you were 30, you had 5 years or so. So that's 35 points. You're going to get 6% contribution. Once you get to 44 to 66 points, it's 7% contribution, and over 66 points, it's 9%. So let's say somebody who is 50 with 20 years of, or excuse me, 50 with 15 years of service. That's going to be 65 points. So they're just shy. They're going to be getting 7%. Then the next year they're going to be getting 9% contributions, and those contributions come in each year, and they're going to grow by the Treasury. It does have a minimum of 0.99%. We're above that obviously right now, so you're going to get that Treasury growth there. And the vesting is going to be a 3-year cliff or age 65. So if you were to come on now, it's kind of a moot point because this plan actually closed in at the end of 2018. So really, it's that anybody that's been in there is pretty much vested already because we're 3 years past that at this point as well. And so what's happened is those contributions start to go into the 401k portion at an additional 6% instead of the cash balance plan. But if you were in there before, you're going to keep getting that. Okay. So going back to the classic defined benefit plan, the Conoco and the Phillips, so let's talk about the different options. Now you've got the single life annuity, the lump sum, and the joint survivor options on all of these. It's just the difference as far as how interest rates calculate out the lump sum. So the Conoco and the Phillips plan, excuse me, again, those are the formula that's going to give you what your single life annuity is going to be. Let's say they run through the equation and they say, you know, Wesley, you've been here with us for 25 years, and based upon your years of service, we're going to pay you $4,000 a month for the rest of your life. Now, at that point, everything else is calculated off of that, whether I want to do a joint survivor annuity to cover my spouse and myself, whether I want to take a lump sum and look at the interest rates. And so if we look at the way those play out, that straight life annuity, the single life annuity, that's going to be paid for the rest of my life as long as I live. So that $4,000 figure I just gave you, whether I live 7 years or 18 years or 27 years, I'm going to get that $4,000 a month for the rest of my life. But again, it's fixed. So obviously $4,000 a month in 10, 15, 20 years is not going to stretch as far as what it does right now. So keep that in mind. There's no cost limit adjustment in there. So you need to factor that in when you run a cash flow analysis and look at a true financial plan to see the potential pros and cons of something like this. The other issue is if something were to happen to you sooner rather than later in life, again, that money is going to stick with ConocoPhillips. It's not going to be going to your beneficiaries unless, again, you're doing a joint survivor annuity with a spouse or significant other. And on that point, you can actually break that up between 10 to 100% continuation and different breakpoints of 10, 25, or 33% breakpoints on that. So let's say that I wanted to make sure my spouse was covered in case something happened to me. I wanted 100% continuation. So if I get that 4,000 for myself, I'm not going to get 4,000 for both of us. They're going to cut that in half because now or not cut it in half, but they're going to cut it down because they're paying out over 2 potential lives. So instead of getting 4,000, maybe we get $3,500 a month for the rest of our lives. And if something were to happen to me first, then she's going to get half of that $3,500. Maybe I did a joint in 75%. Then maybe we're going to get, instead of 3,500, maybe we're getting 3,650. And then once something happens to me, she's going to get 75% of that. So when we run that pension calculation, we can help you do that with the estimate. It'll show all those different choices and options. And we can run through those with the cash flow analysis to show you what's it look like with a individual annuity versus a 50% survivor versus 100% survivor versus a lump sum, and maybe annuitizing that on my own. There's a lot of different options there. So when we get to the actual lump sum option, again, what this is doing, this is looking at interest rates, the Pension Protection Act segment rates, and also Treasury rates to determine, based upon your longevity and your life expectancy and what they're paying you for the rest of your life and interest rates, they run a net present value calculation to figure out, okay, Wesley's getting $4,000 a month for the rest of his life. We need to give him, let's say, $765,000 for him to essentially go out and recreate that. And that depends upon interest rates. Now, if interest rates were to go higher, then they don't have to give me as much. So instead of 765, maybe it's only 725 because I can earn more off of that 725 than what I otherwise would have been able to. Now, if interest rates go down, then they have to give me more. We'll give you an example here in just a moment of kind of how that looks. But really kind of think about it like a mortgage. So when interest rates are lower, you can afford a bigger house, or you maybe afford a bigger mortgage. When interest rates are low, you get a bigger lump sum, and vice versa. When interest rates go up, you're not going to be able to have as high your mortgage payment is going to stay the same, but you're not going to be able to afford as much of a loan. In the same case, your annuity payments are staying the same, but you're going to get a bigger lump sum. So on this example, let's compare 4.5% versus 6%, a 30-year treasury, excuse me, a 30-year mortgage versus maybe 30-year lifespan. So let's assume that the max you can afford for a home is $1,520, or maybe that's also what your pension is going to pay out. So if we're in that lower interest rate environment with that 4.5%, that's going to give you $300,000 lump sum, or $300,000 worth of a house you could potentially purchase. Now, if interest rates went up over the course of a year or two, and now instead of 4.5%, it was 6%, it's not going to stretch as far. It's only going to be $254,000 that you could afford in a house, or 254,000 they're going to give you as far as a an actual lump sum. So let's talk about the actual real interest rates and how those are calculated with ConocoPhillips. Again, there's differences with the Conoco plan and the Phillips plan, but what they're going to be looking at is they use the average, so the fourth prior month, in order to tell you what those different interest rates are for the upcoming quarter. So we actually just got out the December rate, so that means we know what the interest rate is going to be for the second quarter of 2026. And so we've got here the first quarter 2026 and the second quarter 2026. Can't believe I'm saying 2026 at this point. But also, you'll see on the far right-hand side, we actually show the average of the 30-year Treasury as well. That's going to be used for calculation prior to 2009. So there's a couple of different numbers that go in here. You don't need to know the intricacies of this, but just know the interest rates are going to dictate what that lump sum calculation is, and we need to watch those because they do update and change from quarter to quarter, and we can monitor that for you, let you know when the right time is to pull the trigger on these. Because we've seen these ebbs and flows, especially over the last 5 years or so. They got artificially too low with the pandemic, and then they shot up pretty quickly going into 2022. They kind of came back down a bit. Now they're starting to trend back up a little bit here, but we notice again that seesaw pattern up at the top. When interest rates go up, your lump sum is going to come down. When interest rates go down, that lump sum will go up. Now they do use three different segments: the first, second, and third segment. First segment is going to be the first 5 years of retirement. Second is going to be years 6 through 20. And the third year's 21 and beyond. So for most of us, that second segment, having 15 years, is going to have the highest weighting. So that's the number to kind of pay close attention to and see how that's moving. I would need the glass on to look at this and even probably zoom in here for you guys as well in just a moment. But if you look at these, we can see that first line, that top line, the rates for December 2025 are going to tell us what that second quarter of 2026 is going to be. So we're looking at 4.03%, 5.17%, and 6.11%. So you'll see that's actually, it's changed a little bit from the first quarter. The first segment has come up a tiny bit, just 3 basis points here. The second segment's gone from 5.12 to 5.17, so up a tiny bit. And then, the first segment came down a tiny bit, the second segment up a tiny bit, and the third segment is going to be up a little bit more. Net, you're going to see a tiny drop in your lump sum in the second quarter versus first quarter of 2026, everything else held equal. And then the interest rates on the 30 years actually come down a little bit. So it's a little bit of a wash there, but we can look at running an estimate for you for both those quarters to show you what the options are going to be. And keep in mind, this is on top of determining whether or not you've got to do the age penalties associated with it as well. If you look at that second column, the second segment, you can kind of go down through history. I just ran these going back for the first quarter of 2025 last year. I've got these going back 15 years actually, but you can see we're at 4.76%. So we've kind of come up. The actual segment rates that come out every month, they were up. They kind of started coming back down. They bottomed out in October. They started trickling up a tiny bit here the last couple of months in November and December. But here's kind of a quick closer look for you again. So 5.12 and 5.17. What we're looking at there is, again, that second segment rate. So if you're thinking about convincing your benefits now, it may be neck and neck. So it's worth looking at running that. Now, if we think interest rate's going to come down and that 5.17 comes down, let's say to 5 or a little bit lower, you can see a bump in your lump sum. Typically speaking, about a 1% interest rate change equals about a 10% change in your lump sum depending upon your age. So let's say if that 5.17 came down 20 basis points or so, that could be about 2% bump. So if you've got an $800,000 lump sum, it could go up to about 816 or something like that. So again, it is real money to be on the lookout for. So I talked about before running a financial plan. Right now, strangely enough, about 3/4 of Americans over 50 don't actually have a written plan. So if you can spend about 10 to 15 minutes with us gathering a little bit of base data, give us a little bit more time. We'll spend a lot more time running a detailed financial plan for you. And we'll go through that with you, kind of how it ties into the ConocoPhillips situation if you are looking at retiring. Or if you're not looking at retiring, you just want to make sure that you want to know where you are in case you are tapped on the shoulder for another round. We'll be able to go in through that with you, and we can do it as simplistic as you want, or we can get in there and dive deep and run multiple scenarios for you as well. So don't hesitate to give us a call or ask me to run that for you, just so you can kind of see where you stand. And if we've run one and it's been a couple years, take us up on doing it again, because obviously things have changed with the market and interest rates as well, and your plans may have changed also. So A quick refresher. I know we've talked to a lot of you on and off, but who the retirement group is. Again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition to retirement. We've worked with a lot of different companies. Myself, my core companies I work with tend to be ConocoPhillips, Chevron, ExxonMobil, AT&T, and a few others. The reason our advisors kind of focus on just a few companies, it gives us the ability to have more in-depth knowledge of your specific company plan, so we can hold your hand through that transition, let you know what's going on. Another thing not on here, but keep in mind, we did merge with Wealth Enhancement Group last year, or a little bit over a year ago. And that's a great option because we've got a large breadth of resource available to us now. Much larger company, a little bit over $130 billion under management, over 100 offices across America. So obviously we can sit down, do web meetings and phone calls. But if you need to sit down face to face with myself in the Houston area or any of our other advisors across America, that's something that can be accomplished as well. And then again, like I said, our knowledge of not just the pension plan we talked about today, but the 401k plan, healthcare, retiree, medical benefits, life insurance continuation, things like that. And then ultimately take us up on that complementary cash flow analysis. Again, you may have run this yourself and may think you've got something, but we can at least maybe confirm that for you or run something in more detail. There's also multiple levels of review we can dig into. If you have questions about, Roth conversion strategies, different tax planning strategies, we get into all that information with you post running that first financial plan. So with that, we're going to wrap it up. I did see a couple of questions come through here. I'll knock out, but if we don't get to everything, feel free to give me a call. You can reach us at 800-900-5867. You can ask for Wesley or one of the other ConocoPhillips focused advisors. You can reach that info@theretirementgroup.com as well if you just want to send an email. I'll leave these QR codes up here if you want to get into our LinkedIn page to follow along with our ConocoPhillips specific information. And if you'd like to get into our calendars to schedule an appointment with myself or one of the other advisors, we can do that as well. So one of the questions I saw kind of come through here, and I kind of I alluded to this, but didn't elaborate to it. The question is, if I didn't make the cash balance plan, how are my contributions going in now? So I mentioned before, starting in 2019, the cash balance plan was ended. So what's going to happen is you're getting your through your 401k, you're getting your company match. As long as you're putting something in there, you're getting that 6% company match. There's also another profit sharing based upon performances that they'll put in there. But in lieu of the cash balance plan, instead of that 6, 7, and 9%, there's just a flat 6% going in now in that. So again, it's going to be reflected in that portion instead of the cash balance plan. But let's say that you came on, let's say in 2015 or something like that, you are still part of that cash balance plan, so you're still getting those credits. So you may be getting that 7% or that 9% contribution. Excuse me, that 7% or 9% contribution instead of somebody that came in after you a couple years just getting the 6% on there as well. So good question. If you want to review that, just let me know. We can run through those for you as well. So the point of that is it puts a little bit more control in your hands, and because interest rates were so low at that time, that's a benefit as well, giving you more control over it also. One more I'll take a look at here. If I do get cut and I think interest rates are going down, what options do I have? Okay, this kind of goes into really having a conversation with us and the need to sit down one-on-one. But it all depends upon how old you are and what the situation is. But if we had a crystal ball and we knew interest rates were going down, I can see them kind of coming down a bit, maybe popping up a little bit, but I don't see any major shifts or major changes. We'll see if they once Jerome Powell's replaced, if that drives anything. Again, the Fed fund rate is going to drive the short term, not the long term. It's going to be corporate bonds that are really driving the second and third segment here. So it's not a direct correlation, but it could have a trickle down effect. So let's say that you think interest rates are going down, or at least we know the benefit of it is we have a slight crystal ball about a quarter ahead of time what they're looking like, and we just can look at it quarter by quarter. But if you think that interest rates are going down, then you might get that bump in lump sum. But let's assume maybe you're 58 and you got let go or you retire at 58. You're not getting 100% of your pension until age 60. So you could have a double benefit there. If you think interest rates are going down, it could drive up your lump sum, but also while you wait, you're getting aged out of some of those penalties as well. So that could go up. On the flip side, if you've already hit 60, you're not getting any benefit there. So if interest rates stay flat, you'll actually see your lump sum go down a tiny bit because you're losing months of potential benefit that go through that calculation. So that's why it's important to kind of give me a call and kind of run through these side by side to show you. a lot of times it's not just a simple answer as to thinking that you should wait. And then on top of that, there's the opportunity cost. There's no guarantees in investments unless you're looking at CDs or fixed annuities or your money markets. But let's say that even though you think interest rates are going down, are they going down enough? Maybe you got $1 million lump sum, and even if you just put that in a money market, getting 3.5%, that's what 35 grand you could be giving up waiting a year, that you may not make that up in interest rates. So again, just give us a call. We can look through those on a one-on-one basis and run that for you. So again, I want to thank everybody for joining us. Again, even though I've worked extensively with ConocoPhillips employees in the past and know the plans, does not mean we are endorsed or employed by ConocoPhillips. But again, any questions you have, don't hesitate to give us a call. I'll be happy to run through that with you and let you know exactly where you stand and what your options are going forward here. I want to thank you guys, and I hope you have a great day.